This is a national debt clock. It's been in New York since the late 80s, and it shows the gross national debt that we as a nation owe countries, companies, and people that lent us money, almost exclusively in the form of bonds. Back in 1989, it was just shy of $3 trillion. Today, it's north of $30 trillion. And if you look at it by household, there's a reality check, more than $300,000 owed per household. Many worry that a confluence of factors is going to send the U.S. into a debt spiral.
The U.S. routinely is spending more than the country and the government is taking in. So we are living beyond our means.
As of this year, the U.S. is already spending more on the interest of its debt than on national defense. And that's not because military spending is decreasing. The reason is because servicing that debt has become so expensive.
As it stands today, the U.S. Treasury Department spends $1.8 billion to pay the interest on our existing debt. By 2033, that number will be closer to $4 billion. The money that we pay every single day to finance our deficit cannot be spent on roads, bridges, or infrastructure, or our children's future. It is just being spent to finance our deficit.
So how did the U.S. get here? For 2 decades after the clock first appeared, the national debt was considered manageable. But that all changed in the wake of the 2008 financial crisis, when 2 things happened. The U.S. economy shrank and borrowing increased.
Our economy plunged, and we had a lot of deficit spending to try to revive it.
And that's when the current trajectory really grabbed a hold of the country.
By 2013, the continued slow growth, even though it had picked up, and the rising debt put it above 100% for the first time ever. So our debt was above the size of our economy.
This comparison is known as the debt to GDP ratio, and it's often used by economists to gauge the fiscal health of a nation.
Even though that was a high level, it pretty much stayed flat for about a decade.
That is, until everything changed.
COVID happened and our borrowing catapulted higher, sending checks to businesses and consumers. The Fed did their part, cutting interest rates to near zero. While that was helpful, that ended up sparking a spike in inflation. That eventually led to higher interest rates as the Fed had to pivot to combat inflation.
Shut down.
The Democrats have never wanted to stop the amount of spending.
How do you explain to taxpayers that that makes any sense?
Every year, Washington plays political football, avoiding the hard decisions to balance the budget. An 11th hour compromise always saves the day, but it also kicks the can down the road because the underlying problem isn't fixed.
This hasn't escaped the eyes of our U.S. credit rating agencies. Fitch recently downgraded the U.S. credit rating by 1 notch, taking it off AAA.
It was a historic decision based on a lot of wrangling in Congress over our deficit.
Don't forget, pre-COVID, we were spending 20%. The federal government was 20% of GDP in spending.
Right.
It's now 25% of GDP. As outlined in the Wall Street Journal editorial this morning, my father told me, if you're in the hole, stop digging, Stan. All right. So I was actually happy to see when the announcement, the support for Ukraine and Israel, $106 billion. And I was waiting to hear what the offset was going to be. Was it going to be entitlements? Where were the cuts going to be? And the next thing I knew, 2 days later, there was not only no offset, there was $56 trillion in emergency spending. I have kids, I have grandkids. Child care is not emergency spending. It's a priority that maybe should be on the table or not. But we are spending like drunken sailors, okay? So.
Now, Stanley Druckenmiller says the U.S. debt crisis is worse than he imagined and that the Fed is fueling reckless behavior. In a speech Monday at USC's Marshall School of Business, the hedge fund investor said, quote, "The fiscal recklessness of the last decade has been like watching a horror movie unfold." Joining us now is Dan.
I think it's a mistake to assume that everything's hunky-dory.
And, and when stock markets are up, it's kind of like this little drug we all feel. Like, it's just great, But remember, we've had so much fiscal and monetary stimulation. So I'm a little more on the cautious side, that we are facing a lot of things in 24 or 25. And we mentioned Ukraine, the terrorist activity in Israel, the Red Sea, quantitative tightening, which I still question if we understand exactly how that works. I don't think we do. How QE actually worked, what the effect of negative, zero rates was for all this time. And obviously the politics, and and then the Ukrainian war is affecting oil, gas, food, migration. So you have all these very powerful forces that are going to be affecting us in 24 and 25. So if I was the government, I would be preparing for what I'm going to do about that, assuming things aren't good.
The short term we just talked about. The longer term is that we are at a point in which we are borrowing money to pay debt service. And there is a process by which when you keep having debt growth faster than income growth, then that means that you have debt service encroaching on your spending. It's the same for the government as it is for us. And as that happens, and you want to keep spending at the same level, there is the need to get more and more into debt. And the way that works, it's like it accelerates. We are at the point of that acceleration, which creates the supply-demand problem. And it's made worse by the other issues that we're talking about. The internal political issue, the internal social conflict issue there is something that is affecting foreign demand for bonds. About 40% of our debt is sold to foreigners. And so there is a concern of the American politics, of the controlling of this debt crisis and these types of things. So we come back to the same basic question. How strong are we going to be? When we talk about strong, what I mean is also economically strong. And economically strong means financially strong. That means it's just a basic thing. Financially strong means, do you earn more than you spend? And do you have a good income statement as a country? Do we have a good income statement? And do we have a good balance sheet? More assets than we have liabilities. The worse that gets, the more we are going to have that long-term problem. And it's just, you can see it in the numbers. It's just a matter of numbers. We are near that inflection point.
When I dug into history, I discovered that the exact same thing happened in 1933 and had the exact same effect. Then paper dollars were also linked to gold, which the U.S. was running out of because it was spending more paper money checks than it had gold to exchange for them. And President Roosevelt announced on the radio that he would break the country's promise to exchange dollars for gold.
It was then that I issued the proclamation providing for the National Bank holiday. And this was the first step in the government's reconstruction of our financial and economic fabric. The second step, last Thursday, was the legislation promptly and patriotically passed by the Congress, confirming my proclamation and broadening my powers so that it became possible, in view of the requirement of time, to extend the holiday and lift the ban of that holiday gradually in the days to come. This law also gave authority to develop a program.
In both cases, breaking the link to gold allowed the U.S. to continue spending more than it earned, simply by printing more paper dollars. Since there was an increase in the number of dollars without an increase in the country's wealth, the value of each dollar fell. As these new dollars entered the market, without a corresponding increase in productivity, they went to buy lots of stocks, gold, and commodities, and hence caused their prices to rise. As I studied more history, I saw that the exact same thing happened many, many times before. I saw that since the beginning of time, when governments spent much more than they took in taxes, and conditions got bad, they ran out of money and they needed more. So they printed more, a lot more, which made its value fall and made the prices of most everything, including stocks, gold, and commodities, rise. That's when I first learned the principle that when central banks print a lot of money to relieve a crisis, buy stocks, gold, and commodities, because their value will rise and the value of paper money will fall. This printing of money is also what happened in 2008 to relieve the mortgage-driven debt crisis. And in 2020, to relieve the pandemic-driven economic crisis, and it almost certainly will happen in the future. So I suggest that you keep this principle in mind. These experiences gave me another principle, which is to understand what is coming at you, you need to understand what happened before you. That principle led me to study how the Roaring '20s bubble turned into the 1930s depression, which gave me the lessons that allowed me to anticipate and profit from the 2007 bubble, turning into the 2008 bust. All these experiences led me to develop an almost instinctual urge to look to the past for similar situations to learn how to handle the future well. Changing orders. Over the last few years, three big things that hadn't happened in my lifetime prompted me to do this study. First, countries didn't have enough money to pay their debts, even after lowering interest rates to zero, so their central banks began printing lots of money to do so. Second, big internal conflicts emerged due to growing gaps in wealth and values. This showed up in political populism and polarization between the left, who want to redistribute wealth, and the right, who want to defend those holding the wealth. And third, increasing external conflict between a rising great power and the leading great power, as is now happening with China and the United States. So I looked back. I saw that all these had happened together before, many times, and nearly always led to changing domestic and world orders. The last time this sequence happened was from 1930 to 1945. What exactly is an order, you might ask? It's a governing system for people dealing with each other. There are internal orders for governing within countries, typically laid out in constitutions. And there is a world order for governing between countries, typically laid out in treaties. Internal orders change at different times than world orders, though whether within or between countries, these orders typically change after wars. Civil wars within countries, international wars between countries. They happen when revolutionary new forces defeat weak old orders. For example, the U.S. internal order was laid out in the Constitution in 1789 after the American Revolution, and it is still operating today, even after the American Civil War. Russia got rid of its old order and established a new one with the Russian Revolution in 1917, which ended in 1991 with a relatively bloodless revolution. China began its current internal order in 1949 when the Chinese Communist Party won the Civil War. You get the idea. The current world order, commonly called the American World Order, formed after the Allied victory in World War II, when the U.S. emerged as the dominant world power. It was set out in agreements and treaties for how global governance and monetary systems work. In 1944, the New World Monetary System was laid out in the Bretton Woods Agreement and established the dollar as the world's leading reserve currency. A reserve currency is a currency that is commonly accepted around the world, and having one is a key factor in a country becoming the richest and most powerful empire. With a new dominant power and monetary system established, a new world order begins. These changes take place in a timeless and universal cycle that I call the Big Cycle. I'll start with a quick overview, then give you a more complete version, and then direct you to my book if you want more. As I studied the 10 most powerful empires over the last 500 years and the last 3 reserve currencies, it took me through the rise and decline of the Dutch Empire and the guilder, the British Empire and the pound, the rise and early decline in the United States Empire and the dollar, and the decline and rise of the Chinese Empire and its currencies, as well as the rise and decline of the Spanish, German, French, Indian, Japanese, Russian, and Ottoman empires, along with their significant conflicts, as measured in this chart. To understand China's patterns better, I also studied the rise and fall of Chinese dynasties and their monies back to the year 600. Because looking at all these measures at once can be confusing, I'll focus on the four most important ones: the Dutch, British, US, and Chinese. You'll quickly notice the pattern. Now let's simplify the form a bit. As you can see, they transpired in overlapping cycles that lasted about 250 years, with 10 to 20-year transition periods between them. Typically, these transitions have been periods of great conflict because leading powers don't decline without a fight. So how am I measuring an empire's power? In this study, I used 8 metrics. Each country's measure of total power is derived by averaging them together. They are education, inventiveness and technology development, competitiveness in global markets, economic output, share of world trade, military strength, the power of their financial center for capital markets, and the strength of their currency as a reserve currency. Because these powers are measurable, we can see how strong each country is now, was in the past, and whether they're rising or declining. By examining the sequences from many countries, we can see how a typical cycle transpires. And because the wiggles can be confusing, we can simplify it a bit to focus on the pattern of cause-effect relationships that drive the rise and decline of a typical empire. As you can see, better education typically leads to increased innovation and technology development, and with a lag, the establishment of the currency as a reserve currency. You can also see that these forces then declined in a similar order, reinforcing each other's decline. Let's now look at the typical sequence of events going on inside a country that produces these rises and declines. In a nutshell, the big cycle typically begins after a major conflict, often a war, establishes the new leading power and the new world order. Because no one wants to challenge this power, a period of peace and prosperity typically follows. As people get used to this peace and prosperity, they increasingly bet on it continuing. They borrow money to do that, which eventually leads to a financial bubble. The empire's share of trade grows, and when most transactions are conducted in its currency, it becomes a reserve currency, which leads to even more borrowing. At the same time, this increased prosperity distributes wealth unevenly, so the wealth gap typically grows between the rich haves and the poor have-nots. Eventually, the financial bubble bursts, which leads to the printing of money and increased internal conflict between the rich and the poor, which leads to some form of revolution to redistribute wealth. This can happen peacefully or as a civil war. While the empire struggles with this internal conflict, its power diminishes relative to external rival powers on the rise. When a new rising power gets strong enough to compete with the dominant power that is having domestic breakdowns, external conflicts, most typically wars, take place. Out of these internal and external wars come new winners and losers. Then the winners get together to create the new world order, and the cycle begins again. As I looked back, I saw that these cause and effect relationships drove the cycles of rises and declines all the way back to the Roman Empire. I saw how the stories of each one of these cycles blended together with others before, during, and after, in the same way as each individual story blends with others to make the epic 500-year story that is our collective history. And like human life cycles, no two are exactly the same, but most are similar. They're driven by logical cause and effect relationships that progress through stages from birth to strength and maturity to weakness and inevitably decline. However, that's like saying a person's life cycle takes 80 years on average, without recognizing that many are much shorter and many are longer. While age can be a good indicator of future longevity, a better way is to look at health indicators. One can do that with empires and their vital signs too. I found that by watching the indicators of power change, I was able to see what stage a country was in, which helped me to anticipate what was likely to come next. Now, I'll take you through the big cycle in more detail. Give me 20 minutes and I'll give you the last 500 years of history and show you the similar patterns across the Dutch, British, US, and Chinese empires.
It's simple. If people lose faith in the banks, they lose faith in the currency. When they lose faith in the currency, they lose faith in the government. When you lose faith in the bank, the currency, and the government, and someone says, what can you trust? The answer is you can trust Bitcoin.